All right, so here it is. This is an example. We're going to walk through the ultimate mamma jamma kick booty super fast deal analysis software. I'm going to pull a couple of examples and run you through it so that you can see how the tool works. We can talk about what it is used for and what it is not used for, and what the purpose is. So everything that's in orange in this software, which essentially is just built through Excel, it's a pretty simple tool. But anything in orange is going to be an input, and everything else that's in gray is a calculation. Okay, so the only numbers that you can change in this particular spreadsheet are just the numbers that are in orange, and for the ones in gray we have a few assumptions in there. So it's not going to be exact, and you need to keep in mind what is the purpose of this software. So as a real estate investor, you are going to be looking at lots and lots and lots of deals, right? And if you spend an hour or two really digging in and analyzing each one, or more time, you're going to find that a lot of the deals that you're spending so much time on, they were never deals to begin with. No matter how you cut them, they weren't going to be a deal. So wouldn't it be nice if you can fairly quickly assess that right up front, and that way you know whether to spend the time on it or not. So whether a deal is a deal or not is also going to depend on what your financial goals are. So if you are, I live in San Diego, California. I do not invest here, but obviously people do. So if your objective was to have, single digit return, a low single digit return, but you want to own property in, a class A market, and a very good market that has, probably the most chance of appreciating, then, you might be okay with that low return. And if you are a cash flow investor and you want to maximize the return on your investment, then you're going to go to a market where the numbers make more sense. You're not necessarily going to see the kind of appreciation you're going to see in this kind of market, but it's, slow and steady wins the race. Okay, so a big part of it will depend on what your objectives are. So let's just run through what's in here already. Was just an example I had thrown up. So let's walk through this one, and then I will put up another example. So let's say that we're looking at an 8-unit building that's $275,000 is the asking price. Okay, so for purchase price, I'd usually start with the purchase price. So if you don't have a purchase price, or you don't know what the seller's asking, you can put in any number you want. And alternatively, even if they're asking $275,000 and you want to see how the project would perform with an offer price of, say, $240,000, then you could plug that number in and everything will adjust. Okay, so let's say for now, for this example, that they are asking $275,000. Okay, and let's say that you are going to put down a 25% down payment. In the world of multifamilies, if you are buying a property that's already performing, so this is not an underperforming building, it's a performing building, you are going to put down on average anywhere between 25 and 35% as a down payment. Okay, so that's important to know, and it doesn't mean it has to be your money. So I'm big on no money down investing, but it does take capital. So in a case like that, you're going to have to get creative and either partner up with someone, or use a line of credit or some other means of financing to pull that down payment. But cash is going to be required from somebody somewhere. Okay, a conventional bank is not going to give you a 100% loan on an apartment building. So that's just a little bit of a reality check there. Okay, so the next one, interest rate. Let's say I put 6%. I mean, right now, if you have good credit, you're probably looking at more like 4.25. But let's say it's 6% for the purpose of this example. Amortization period, this can be anywhere from 25 to 30 years. So a more conservative number would be to put in 25 years, because that's going to make your payment higher, so it's going to make your cash flow lower. So it's conservative. If you want to pull your payments out over 30 years instead, then you can increase your cash flow because you'll be paying less of a mortgage payment every month. Okay, so 25 to 30 years is realistic. In this case, it was an 8-unit building, and in this example, we use an average monthly rent of $600. Okay, so from there, everything else calculates automatically. So a 25% down payment on a purchase price of $275,000 is $68,750. So at least you know what capital you're talking about. That means the loan amount would be $206,000 and change. Income, so the way I've calculated in this, I've just built in a 10% vacancy. I know that a lot of realtors that put out annual property operating data sheets, which is essentially the profit and loss statement for an apartment building, will use a lower vacancy like 3%. 10% is it's more conservative. And unless they truly have a lower vacancy rate, I think that 10% is a fair number to use. Okay, so for expenses, again, I'm trying to give you a single tool that kind of can account for everything. So 40% is a conservative number. I've seen buildings that have, lower, 32, 34%. 40% is a reasonable amount to put when you're just doing a high level analysis. Okay, so what we have here is the net operating income. So net operating income represents essentially your cash flow at the end of the year if you had no mortgage. So it's the income of the property minus the expenses, but not including the debt service payment. So in the world of multifamily, debt service payment is not included in net operating income ever. Okay, annual cash flow. So to calculate your annual cash flow, we take your net operating income, we subtract out what the mortgage payments are going to be, so this is all calculated for you, and we have your annual cash flow. So now you know what amount of money, dollars, you're going to have at the end of the year from this deal. Okay, and then finally, we want to know, how is your money working for you? So if you put down a down payment of $68,000 and change, and you had annual cash flow of $15,000, that's about a 22% cash on cash return. So anyway, it's important to do this because you want to make sure that the deal makes sense. Especially if you're putting up your own capital or a partner's capital, these numbers need to make sense. So let's say that this same building was in a more expensive market, and let's say the purchase price is going to be $500,000. Okay, so let's change it to $500,000. Let's scroll down real quickly and see what we're looking at. Okay, so look at that. Your cash on cash return is down to 1.69%. Okay, that stinks. So anyway, you're not going to pay $500,000 for a building like this. I mean, realistically, you're looking at annual cash flow of only $2,000. So why would you put that much money up for that? So, but that's how this works. You can play with this and see. Let's say you wanted to offer, $225,000 for the property when they're asking $275,000. You can scroll down and see, okay, I would have about an $18,000 a year cash flow from that, and that's about a 32% return on my down payment. So that is how you use this software. Now, keep in mind that the way I have it set up, it has one cell for the number of units and one cell for average monthly rent. Now, the reality is that most buildings out there have more than one type of unit. So let me just show you real quick. What you want to do is you want to come up with an average. So let's say, for example, you're looking at a building that was 8 units, and let's say 5 of the units were 2 bedroom, 1 bath. And let's try this again. 2 bedroom, 1 bath. And let's say those units rented out for $750 per month. Okay, so if I have 5 units times $750 per month, that is $3,750. And let's say I have 3 units that are 1 bedroom, 1 bath, and let's say those are $500 a month. So we'll take 3 times 500. Okay, so our total, and you can do this, you can even do this by hand, our total amount of rent each month is $5,250. And there's 8 units, so let's say $5,250 divided by 8 equals an average rent per unit of $656. So if you have, and I'll show you where we put that in, if you have a situation where you're looking at a deal and it has multiple unit types and things, that's what you do. You just multiply them out so that you can see what the total monthly rent is for that unit type for the building, and then add them all together so you see what the total rent is for the building, and you divide it by the number of units, and that will give you your average monthly rent. So in this case, let's take that $656.25 and bring that back to our spreadsheet. So that you're going to plug in $656.25. Okay, and that's going to go ahead and flow those changes through. So I'm going to undo that change real quick so you can see the difference. Okay, so we went from $600 for average rent right there, which gave us about a 32% cash on cash return. And if we change it to $656.25 as a monthly rent, then our cash on cash return went up to 37%. Okay, so this is just a quick tool so that you can get a snapshot of what the property is going to do, what your options are. You can play with down payment. Maybe you're going to put down 35% down payment, and now you want to see, okay, that means we're putting down more of a down payment, so that's going to lower our cash on cash return. We will have a higher cash flow. Anyway, so that's what this is for. So you can change the amortization period, number of units, average rent, interest rate, purchase price, and it will give you a quick idea of whether this is worthy of your time. So I hope you have found this helpful. I am excited to be able to provide you this tool, and hopefully it's going to save you a ton of time. And as you get going down your real estate investing path, I look forward to coaching and mentoring you through that process and helping you to maximize your financial return and your success. Anyway, have an awesome, fantastic week, and we'll talk to you soon.